Hi everyone. Today's lesson is VaR mapping. So we will look at a hypothetical example of a portfolio and try to illustrate the concept of mapping a large number of individual positions to a smaller set of risk factors and how this may help us in calculating VaR or any other risk measure for a portfolio. So the hypothetical example is a portfolio of $1 million invested across 10 different positions. So we have 7 stocks and 3 different bonds with different maturities. So 1 year, 4 year, and a 10-year bond. And we have 7 different stocks across different sectors, but all belonging to the U.S. equity asset class. So there are a couple of reasons why we would want to map these positions to broader risk factors in the first place. So the first reason is the correlation estimation. So as you know, to properly account for risk or to estimate VaR of this portfolio using individual positions, we will need to estimate the correlation matrix amongst all of these positions. So we will need a correlation coefficient between Microsoft and IBM, between Microsoft and Chevron, between Microsoft and 1 year bond. So we will need a correlation for each pair of these positions. So with 10 positions, it turns out that we will need 45 different correlation terms. The formula for it is 10 times 10 minus 1 divided by 2. So I have the formula here. So with 10 factors, um, we need 10 times 10 minus 1 divided by 2 correlation terms, which is 45 different terms for a portfolio of 10 positions. For a larger portfolio, so in real life, we can have a portfolio with 100 positions. With a 100 position portfolio, the number of correlation terms is almost 5,000. And for a portfolio of 8,000 positions, we need almost 500,000 correlation terms. So you can see that as the number of positions grows, the number of correlation terms to estimate grows exponentially pretty much. So it becomes really, really cumbersome and time and effort required is very vast. So you may not even need to do that. Uh, by mapping these individual positions to a number of risk factors and save a lot of time, a lot of money, a lot of effort, and not actually lose too much accuracy in the process. So, uh, another reason why you would want to map individual positions to general or broader risk factors is that you may not be able to properly assess a risk of a particular security. Let's say there was a technology stock in our portfolio that doesn't have too much history. For example, there was an IPO recently and we just acquired this stock. So to estimate the volatility of this stock or the risk of this stock, you don't have enough history to do that. So instead of that, you may recognize that it's a technology stock, so the risk will be very similar to that of the technology sector. Or if you want to go even further, you may just realize that it's an equity, it's a security that belongs to the U.S. equity asset class, and that the risk profile of the security will be very similar to that of the other U.S. equity asset class securities. You may lose some accuracy, you may lose some granularity with that approach, but you gain your other benefits such as um, the efficiency and the time saved. So here's the example. We have 10 different positions, $100,000 invested in each of these positions for a total of $1 million. How can we use VaR mapping approach? Um, so there are two different general risk factors that I chose for this example. One of them is a sector and the other one is an asset class. So we have stocks belonging to two different sectors, technology and energy, and we have all bonds belonging to the same sector or class known as corporate bonds. Um, all stocks belonging to technology sector, and we have $300,000 invested in technology stocks, we can map all of them to the technology sector represented by a S&P 500 technology sector ETF, for example. And all the energy sector stocks, we have $400,000 invested in them. We can map that $400,000 to the energy sector of the S&P. And all of our bonds, uh, we have $300,000 in invested in corporate bonds with different maturities, but we can pick the average maturity of them. So we have a 1 year, 4 year, and a 10-year maturity on average. We can pick a 5-year bond and say that we have $300,000 invested in a 5-year bond, and our risk will be similar. The risk of this portfolio, the mapped portfolio, we can assume that it's very similar to the risk of the original portfolio. And please note that the total market value of the mapped portfolio must match the total market value of the original portfolio. For risk purposes, the VaR mapping process requires that market values are mapped directly. So this portfolio now has only three components. It has $300,000 invested in S&P 500 technology sector. We have $400,000 invested in S&P 500 energy, and we have $300,000 invested in a 5-year bond. So now all we need to do is estimate the risk of each one of these components, and we need to estimate three different correlation terms as opposed to 45 correlation terms. And when we do that, we will arrive at VaR of this portfolio and assume that that VaR of the portfolio will be very similar to the VaR of the original portfolio. Of course, as you choose the level of granularity for your risk factors, you're pretty much balancing between accuracy and speed. So the smaller the number of risk factors that you choose, the higher the speed will be, but the less accuracy you will gain. So this other example is if you just map each position to the asset class without regard to what sector they belong in, if you just map all of your stocks in your portfolio to the equity asset class represented by the S&P 500, and again, all of your bonds in the portfolio, you will map to a U.S. fixed income asset class, and you will pick the bond with the average maturity of all of your bonds. So here you now have only two risk factors, S&P 500 and a 5-year bond with $700,000 and $300,000 invested in each respectively. And again, your total market value is $1 million. So now you only need one correlation term. You only need a correlation coefficient between the S&P 500 and a 5-year bond. It makes your process much more efficient, faster, and easier. And especially if you have to do this every day for a different portfolio or for a portfolio that changes, it will help a lot with your timeliness and efficiency um, without having to lose the risk profile of the portfolio. So now to reiterate, or I guess to summarize, uh, when you choose the general or we call the primitive risk factor, such as the sector or asset class, to map your individual positions to, the disadvantage is that you lose the accuracy. So by ignoring each specific, the risk factor of each specific position, you lose the accuracy of that information and you also lose the granularity of risk. So instead of actually working with the volatility of ExxonMobil or with the volatility of one-year bond, you're proxying that risk factor to the S&P 500 sector or the broad index. So that's the disadvantage of that when you do that. But the advantages are the biggest advantage by far is that you gain speed and efficiency. With the number of correlation terms required, it drops significantly as you map the number of positions to a smaller number of primitive risk factors. Number one advantage is that you gain speed and efficiency. The second advantage is uh, that it counters the disadvantages that you lose the granularity of each position. But you may argue that for a large enough portfolio, the idiosyncratic risk, the specific risk that each one of these positions has that you're ignoring by mapping, it actually gets diversified away. So you don't actually lose much granularity by mapping all of these positions to their respective sectors and asset classes because it's diversified away and it's not even relevant anymore for large portfolios. And even if there is some idiosyncratic risk remaining after you map these. Basel regulations actually they have a specific charge. It's a charge, the capital charge that's known as the specific risk charge. So if we do that, if we uh, map individual securities to risk factors, Basel Basel regulations will actually dictate that we take a specific risk charge to account for that idiosyncratic risk, and we will need to set aside enough capital to account for the fact that one of these stocks may be more volatile and more risky than the overall sector. So that's the third advantage. So we had three advantages. We gained the speed and efficiency. The second advantage was that the risk associated with each individual security is actually diversified away, so it's not even that much relevant. And third advantage is that the specific risk charge will actually be set aside when we set aside capital for the bad days. So VaR mapping is actually a very common practice, and it's very efficient and it's very useful. Now let's take a look at how we may map a fixed income portfolio. There are three approaches, three mapping methods for a portfolio of bonds that was presented by Jorian in his Value at Risk book. And I just used that same example and we'll go through it and try to understand what this means and how we map fixed income securities. So we have a portfolio, a $200 million portfolio consisting of two bonds. We have a 1 year, I'm sorry, $1 million invested in a 5-year bond paying a 6% coupon. And we have a $1 million, $100 million invested in a 1-year bond paying a 4% coupon for a total of $200 million. So we have a $200 million portfolio, bonds of different maturities and different coupons. So what we do is we break down the cash flows, first of all, across the 5 years. So during year one, the 5-year bond pays the $6 million coupon. In the second year, it pays a $6 million coupon. Every year, it pays a $6 million coupon, and at maturity, it pays the $100 million principal plus the $6 million coupon for a total cash flow of $106 million. The 1-year bond just pays the principal and coupon at the end of year one. We're also given the yield curve, the spot rates for each of the years. And we can notice that this is an upward sloping yield curve for this for this scenario. Now, the three different methods to map this portfolio of two bonds is principal, duration, and cash flow mapping. And these are sorted from the most basic, the easiest one, to the more complex one. But as we go up in complexity, we gain accuracy. So again, the balance here is between the speed and accuracy of when we choose the mapping process or method. So principal mapping is the easiest one, is the most crude one. It's the least accurate of the three. We have two bonds, one with a maturity of 5 years and one with a maturity of 1 year. What we do is we map the entire $200 million portfolio to one bond of the average maturity of our portfolio. So the average between 5 and 1 is 3 years. So here we assume that the entire $200 million is invested in one bond with a maturity of 3 years. And then we hopefully have the VaR or the risk of that 3 year bond, and we just apply that risk um, to our total portfolio market value of $200 million, and we assume that our portfolio risk will be the same or similar to the risk of that one bond. Uh, and that turns out to be $2.97 million using the principal mapping method. Now, with the duration, it's a little bit more accurate than principal mapping. Instead of using the average maturity of our bonds, we use the average duration of the two bonds, and that turns out to be a 2.733 year bond that has the same duration of as the average duration of our bonds. So we assign the entire $200 million of our portfolio to one bond with a duration of 2.7 years. And that bond has a little bit lower risk than the 3 year bond, and the VaR of that portfolio ends up being $2.7 million. Now, cash flow is a little bit more complex. It's a little bit more accurate. The cash flow method to map these bonds actually takes into account cash flows at every point in time. So during year one, here I break it down by future value and the present value of the cash flows. So during year one, the first bond pays $6 million and the second bond pays $104 million for a total cash flow of $110 million at the end of year one. We take that 110 million and we discount it back at the spot rate of 4%. When we discount the $110 million to today, we get a present value of that cash flow of 105 million, $105.77 million. During year two, we only get the $6 million payment from the bond number one. That's the $6 million cash flow, and we discount it back to today using the rate of 4.618%, and we get the present value of that cash flow at $5.48 million. We do that for every year, so you'll see that at the end of year five, our cash flow is 106 million with discounted by 5 years using 6.112% spot rate to arrive at the $78.79 million, which is the present value of that particular cash flow. The logic here is that you will assume that you have $78 million invested in a 5 year bond. You will have $4.8 million invested in a 4 year bond. You'll have $105 million invested in a 1 year bond. And when you sum up all those market values together, you have to arrive at the same market value as your original portfolio, which is the $200 million. So If you had a portfolio of 100 different bonds, but all of those bonds had cash flows within 5 years, you can map all of that risk to a small set of five bonds of maturities of 1 to 5 years, and then you can assign or map a portion of your portfolio to each one of those bonds, and then calculate your risk of the portfolio using that simplified mapped method. So for fixed income, it makes a lot of sense, in particular because we know that bonds, you can't just take a bond that's maturing in 5 years and use its historical volatility for the past 2 years and approximate its risk that way, because bonds, by definition, by their sheer nature, they change their risk profile every day as they age. The 5 year bond today has a very different risk profile as that same bond will have 4 years from now. 4 years from now, it will become a 1 year bond, and it will have much smaller risk. Uh, so now the accuracy of these three mapping methods, as I said before, principal mapping is the easiest one, but is the least accurate of the three, and cash flow method is the most accurate, but also most complicated of the three. So here are the numerical estimates of the VaR of this portfolio using three different methods. And you can see that as we go up in complexity, we get closest to the real VaR of $2.57 million. And again, this is VaR mapping for fixed income portfolios. And I hope this was helpful. Thank you for watching.